You were not meant to be a slave to the grind. You were not meant to trade your life force for money. You can escape gravity. You can unlock your life. You got this. Let's go.
Hello and welcome to Unlock Your Life. This is your host, Jennings Smith. Guys, I've got a real treat of a guest here. Kevin Bupp was kind enough to have me on his podcast, and I wanted to share his message with you guys today because he's kind of focusing on a niche that I definitely don't know much about, and I want to hear more about that. And he's been in the business a long time, $250 million worth of real estate transactions. He owns apartments, single family medical, self-storage. He's even got an office building, which everyone's scared of today, but he's plunging in with that. He's an author of a book, The Cashflow Investor. If you hang around, I'm going to tell you at the end how to get a free copy. He's going to send you a free PDF copy. And if you want a real copy, you can even get that. Just pay $6 for shipping. But Kevin, man, thank you for coming on the show. I appreciate you and welcome.
Jennings, thanks for having me, man. I'm excited to be here.
Awesome. So, dude, let's get right into it. You piqued my interest with parking lots and mobile home parks. Now, I have owned a couple mobile home parks. I sold them because I wasn't great at managing them, but I know there's money to be made there. And parking lots I've never done, but I like the idea of buying a square of dirt. I guess I do parking lots with some of my self-storage stuff. I got parking there, but yeah, I'd like to kind of focus on those asset classes and tell people, how did they get started? Why did you get into mobile home parks? Like, what was the attraction? Because there's so many assets we can pick in real estate. And I know you do them all, but that seems to be a focus of yours.
Yeah, no, it's a great question. And I didn't know too much about mobile home parks when I first started investing in real estate. So I was 19. I started like a lot of folks do. I started buying single family homes and fixing up, rougher homes. And initially it was, to fix them up and keep them as long-term rentals. And then I realized that it would take a long time for me to be able to buy the second one, the third one. So I kind of evolved my model to buy 3 homes, wholesale 2 of the 3 and then keep 1. And then I did that for quite a period of time, built a big portfolio of single family homes back in my early to mid 20s, and then started buying apartment complexes back then as well. And then, apartment complexes open up my eyes to just the bigger game, commercial real estate in general, just bigger deals. I realized, the inefficiencies that existed with trying to buy, 100 single family properties. It's just a lot of energy, a lot of work, a lot of resources, and it's much easier to buy 100 doors underneath one roof or one property. And I felt the same way about commercial real estate. Back then, my first exposure was to self-storage. This was back before self-storage was as sexy of an asset class as it is today. But then I got introduced to, a litany of others as well, office, retail. I've owned just about every type of real estate. And, fast forward to, 2008, my residential portfolio suffered dearly down here in Florida in 2008. And it took a couple of years of damage control and working through just a fallout of the real estate market down here. I mean, it was just like ground zero. Yeah. And I was looking for a way to rebuild. And it took me a couple of years to really even think about rebuilding. But when I was ready to do that, I knew that, and I felt that multifamily was going to be the way, and I wasn't considering anything else. But I had a lunch one day with a guy named Randy, and Randy owned mobile home parks. He had been a banker for 30 years and then retired. And for his retirement, since he had I guess he had a number of clients that owned mobile home parks here in Florida, and he always got to see their P&Ls, and it was like, I need to take my retirement funds. And he went and bought 3 mobile home parks. And that was his retirement. They were really nice ones. And he's like, you need to consider these. And so after a 2-hour lunch out with Randy one day, I was introduced to him by a friend. I was like, I'm going to go buy a mobile home park. So this is like 2011. And fast forward about a year, I looked, I found one. I bought a mobile home park in Atlanta, Georgia, which we literally owned up until like a year and a half ago. And then it went well, bought the second one, bought the third one. It was all my capital or, a private investor capital, like, just friends, families, stuff like that. And then felt that I had a really good niche. And just like, how these things sometimes come together, they perform well. My ROI was way higher than what I anticipated. And back then there wasn't a lot of competition in the space. Banks didn't understand the asset class. So it was really hard to get lending. So a lot of owner financing deals got done, back in the day. Today it's very different, but we just kind of had a free for all and started buying parks left and right. And and we're still buying them today. Our business models changed slightly. We buy much larger communities today than maybe what we would have bought back then, but we're still pretty much the same. We still look for the same underlying fundamentals when we're looking at a park in the market, and it's treated us quite well.
Walk me through that Atlanta deal. Like how big was it? How much was it? How'd you find it? And what attracted you to it?
Yeah. So again, remember, this was back in 2012. So a very different landscape than what we're in today. Lots of distressed real estate. Like, Atlanta, South Atlanta got hit really hard. Like that's where a lot of the growth and the push was happening. And so, 2011, 2012, Atlanta still had not recovered from the housing crash. And a lot of markets hadn't. They might have been coming on the upswing, but like they were still foreclosures and REOs and just, half-built developments and things like that. So this deal was kind of at the fringe of a lot of the new push where like the new retail strip centers were going in and new housing developments were going in. But a lot of the starts, never got started, or maybe made it partial away. And this deal, long story short, it was an REO, it was a bank owned. And the story goes that the guy that owned it before us, that lost it to the bank, he had bought it about 15 years prior. He was a slumlord. I guess it was a really rough rundown park. It had really crappy homes in it. It was all rental homes. And he was just that. Like, he was known in the area as a slumlord. He didn't keep up. Code enforcement was always on him for these roads, for potholes, and for trash and all that. And at some point during that stage, one of the hurricanes had hit the Gulf Coast somewhere. I forget which hurricane it was. And when hurricanes hit, FEMA comes in and gets a bunch of temporary housing, mobile homes, and they go put them in places where people have been displaced, to give them a place to live while they rebuild. And then once they're done with those, they normally auction them off. They have FEMA government auctions. And so this guy went and bought. It's a 34 space park. He went and bought 29 of these lightly used. They're only like 2 or 3 years old, FEMA mobile homes. And the local city said, well, in order for us to allow you to replace the homes that are in there, you need to do X, Y, and Z. Like, you need to finally improve this park. So he put new roads in, he put new infrastructure and water and sewer lines, and he brought all these homes in, took out a bunch of debt to do that from a local bank, but then continued running it like a slumlord. And so, long story short, he over-leveraged it based on his business model, and he lost it. And we ended up picking it up about 3 years after. It was in horrible shape, had been vandalized, all the AC units stolen. We paid $200,000 for it. It was a 34 space park, had 29 mobile homes in it. They all came with the sale. We paid $200,000 for it. Put another, I think roughly probably about $300,000 of just rehabbing each one of those respective homes. And then, within a year and a half, did a cash out refinance, got 100% of our money back out of it. I think it appraised at that point in time for like $1 million. And then, it was a phenomenal deal. I mean, like it net after debt service and expenses, it cash flowed just at about 6 figures a year. So $100,000 a year for that small asset.
What'd you do with those homes? Did you sell them off owner finance? Did you keep them rentals, or what'd you do?
That's a good question. And so again, it all goes to the market that you're in, right? And so again, remember this area was still kind of on the fringe. It was like today, it's a very different place. Today, you would be able to find buyers that had 25, 30K to come in and buy those homes. That would be no issue. Back then, we tried to sell them. In a perfect world, we would have just sold them off and had lot rent underneath. Mm-hmm. But it just, the market wouldn't support it. It wasn't that market. And so we did rentals or lease options. Lease options, that demographic is still a rental. Most of the time they turn over every 12 or 18 months. And so you're dealing with a C-class tenant base, but it was fine. We got good rents. We got really strong rents. I think we were renting them on average for about, at least in the beginning, about $700 a month. I think by the time we sold it, they were probably $900 a month, or maybe even slightly higher than that. And, it ran well. I think we sold it, appraised for $1.4 million. And, life was good. So we saw that as the case study, right? Like that became how do we replicate this particular deal? And what I realized is that I like fixing things up, and I've fixed up hundreds of homes. I've done major rehabs. This was probably still to this day, not the heaviest rehab per se, but it was zero cash flow. There wasn't a person living in it when we took it over. And so, I mean, it was zero cash flow for 8+ months. And so I don't like that model. That model works if you're truly buying at such a low basis where you can't lose. And we kind of did there. But fast forward to today, we're a value add player. That's what we like to buy. But we like to buy things that are it may not stabilize, but they've got cash flow coming in and there's some immediate upside potential, but we can at least cover our operating expenses while we're doing the rehab and value add piece.
So it's funny because the first mobile home park I bought, it was almost carbon copy. I mean, it was 30, I think it was like 32 units or 36 units. It was half empty. Now we did have some tenants there paying, so there was some cash flow, but yeah, we bought it for 180,000 cash. We ended up putting another 150,000 in like moving in homes and filling up the rest of the park. Mm-hmm. So it was a mix, like about half tenant owned homes, half rentals. But then, we got an offer for 750 18 months later and we sold it. And I was like, wow, that worked. And I was only the money guy. Like I brought the down payment for them and they did all the work and I got 50% of the equity for raising the money. And I gave 20% to the guy that actually brought the money and he got a 9 pref on his money. So I got 30% of the deal for fairly little effort, but it did go really well.
Yeah. It's a good business. Again, it's evolved quite a bit. It's very different today than what it was even just, it's very different today, even what it was like 6-7 years ago. Even from a lender perspective, back then I remember banging my head against the wall for the first couple of years. I'd find deals, great opportunities ahead, good underlying fundamentals, economically we're stable, we're in good markets. And would have to go talk to 10 banks and get turned down by 9 of them just because they literally didn't understand the business model at all. And it's a very simple business model. It literally is not complex at all in nature, but mobile home parks really got a negative stigma and they got placed into this bad bucket. Like they were all bad. No matter even if they made a lot of money on paper, like look at the P&L here, guys. Like what are you not seeing? Like, aren't you a bank that's supposed to lend on stabilized businesses, that cash flow and that are safe investments? Well, here you go. It's been around for 30 years. It's not going anywhere. But a lot of banks, they just didn't get it. There was a fear, and that's changed. It's shifted. Now banks are clamoring to put money into mobile home parks. Fannie Mae, Freddie Mac, the agency lenders they love the space. There's CMBS lenders. There's local, regional, national banks. I mean, they all love it now, but 10 years ago, that definitely was not the case.
So if I'm a guy out there and I've got some rentals, maybe I'm in your position, what would you look for? How would you say, this deal might have potential and I'm going to dig deeper into that? And what size would you recommend somebody start with?
Yeah, those are great questions. I mean, first and foremost, it's all, everyone heard the saying location. That's definitely the truth. I mean, I was having a conversation the other day with a good friend of mine. He owns, about 7,000 apartment units, but we're talking about some of the deals that didn't go as planned. And one of those deals was it's in Austin, Texas, which, everyone just thinks broad blanket approach. Austin, you could buy anywhere in Austin and it's phenomenal. But Austin's got bad neighborhoods also. I mean, it does. Every area's got bad neighborhoods. And they bought this deal and they did the rehab. They were putting in X amount of dollars per unit. And this guy's a good operator. He knows his business well. But you don't always hit it out of the park. Some deals just don't go as planned no matter what you do. And after like 18 months, like literally it was surrounded by a bad neighborhood. And so where I'm going with the story is like, you can't change the neighborhood. Unless you buy the entire neighborhood, you can't change the neighborhood and you can't change a market. And so if it's a crappy market, but it's a pretty property, you're not going to change the market. More than likely, you're going to have to pay a lot of extra money to keep that thing pretty. And you're never going to be able to attract the ideal tenants that you want there. And the same thing happened with him. He took this ugly property that was in Austin, a great market, but in not the most desirable neighborhood, tried to make it pretty, to change things around. But the outside negative elements kept coming in and stealing things. He had a homeless problem. And anyway, he ended up losing money. He literally lost money on a deal in the last 5 years in Austin, Texas. Like that doesn't even make sense, right? To most people. And so location is important. Just know that you'll never be able to change the market. Don't ever just shop based on cap rate. You see these deals come out on, through different wholesalers or on LoopNet or whatever, and it's got a 9 cap or a 10 cap or something like that. But it's in like, I don't know, some podunk area, Alabama, right? No offense to Alabama, but it's in the middle of nowhere that has no underlying economic stability. There's not jobs. It's poor. You're not going to be able to fix that. I don't care if you dump a bunch of money into it. So first and foremost, buying a good market, good, strong market that has demand for affordable housing. It doesn't have too much excess affordable housing because there's some markets out there that there's not an affordable housing crisis. There's some areas where it's still cheap to live. And then as far as size, I don't think there's a right or wrong answer there. I mean, I have found that that first park I bought is probably about the smallest that we wouldn't even consider that park today, just because our business needs more scale in order to, justify buying something. But, if I was just buying it for myself, I look at it as how much top line revenue does this community generate? And can that the revenue afford to have someone on payroll that's at the community, someone I can actually pay a reasonable wage to, that's got a brain, that can run the day-to-day operations, that knows how to use a computer, that can handle, handing out notices and, handle the day-to-day property management there at the community itself. And that's a big piece of it. If you literally, you don't have enough money to pay somebody because your community only generates, top line, it generates $50,000 a year. And after it's all said and done, your NOI is $25,000. You really don't have that much money left over to pay anybody anything, to do anything in that community. And so that's going to be a challenge. That means you're going to be in the trenches. You're literally going to be there. You're going to be the guy, and you're not going to be able to afford to pay anyone to actually manage or oversee it. And so finding that scale that's necessary to have enough top line revenue to be able to afford an on-site manager. That's first and foremost of importance. And then some of the other things to consider is, depending on what type of utilities it has. Like I see a lot of communities that have septics, they have private water, private sewer. Well, those systems are more expensive to maintain and operate over long term. A lot of people argue that septics are cheap. You literally have to get it pumped once every 5 years, but things happen to those septic systems. Components have to be replaced. They do have to be pumped, but you have leach fields that go bad. Wells, the same thing. Well, people are like, that's cheap water. It's coming out of the ground. It's free. No, there's chlorinators and all kinds of equipment that goes in. There's state testing that has to be done, and it's very expensive. And so you want to make sure that your park's got enough revenue to where if you have a major CapEx expense that's not planned for, like a $5,000 chlorinator going out, that doesn't wipe out 20% of your take home on that park, right? So again, scale is important. I think 40 to 50 spaces is kind of like a safe bet to where you've got enough revenue to deal with some of those nuances without completely knocking out all of your potential profits for an entire year.
Yeah, absolutely. There's definitely things to watch out for. Yeah, we bought a 12-unit mobile home park, and that was a mistake. It was just too small. We ended up selling it. I think we made $100,000, but it was like a huge headache. And it was all park-owned homes, all rentals, and every time that little deal gave us more heartburn than a lot of our 50 and 100 and 200 unit apartment complexes.
Absolutely. So, well, that's also probably because you guys were you were direct to the source as well. I'm assuming maybe correct me if I'm wrong. Did you have a strong on-site manager that kind of managed the day to day? Or were you guys the ones that,
we were the,
that's it.
We did a lot.
You got to put that layer. You got to put that layer in between, but you need to have a good layer, and you can't afford to pay a good layer in between for, one to 12 space park.
I got it. Okay. So parking lots, tell me a little bit about that.
Yeah. it's got a lot of similarities to mobile home parks. People are renting space to park their vehicles. And so we buy parking lots in, high demand downtown CBD locations where there's limited parking supply, or in highly visited tourism locations. So for example, I'll give you 2 examples of parking lots that we just bought recently and kind of what the business plan is of each. And so we just closed on one 2 weeks ago. It's in downtown Phoenix. It's a parking garage. It's a stone's throw. When I say stone's throw, it's the closest parking garage to Maricopa County Courthouse, which is the second largest courthouse in the country. And so you've got all the activity that a courthouse gets. It's massive. And so that parking garage is the primary one for that. It's right up the road from where the Phoenix Suns play, like literally 2 blocks away from where the Phoenix Suns play. It's another 2 blocks away from where the major entertainment venue is in downtown, where Elton John and Billy Joel and all those guys play. It's also got a nightlife down there. So it's got all these demand drivers. It's also got some office, which isn't the most desirable, but the majority of the demand drivers are not related to office at all. They're related to bars, restaurant, residential, entertainment, sports, and courthouse, all of which the majority of those aren't going anywhere anytime soon. Office, whatever, it's having its challenges and probably won't ever be back to what it was prior to COVID. And so to us, we looked at that, and first and foremost, we know the owners. They haven't really injected any money back into it for a number of years. It's got old equipment, old gates, old operating system that there's traffic jams trying to get in and out of it, and people know that. And so sometimes people don't park there because they don't want to get stuck behind 20 cars trying to get out. It's got some deferred maintenance on it, but it's built fairly stout. And so we basically looked at it and says, We know that there's being money left on the table here. The current operator that's managing the day to day, they're an antiquated company. They don't leverage dynamic pricing. So like when there's like big events, for example, there was a big act there. It just happened a couple of weeks ago, and all the other parking lots in the area had a flat fee of anywhere from $50 to $60. This parking garage, just before we closed on it, was at $30. They didn't adjust it accordingly. They don't have the technology or the software to actually understand what the supply and demand economics are and where their pricing should be given what everyone else is charging for parking. And so it filled up, but it filled up at half the price of what it should have. So we're going in, upgrading the technology, upgrading the operating system, putting a better management company in place there, fixing deferred maintenance, and we're looking to drive be able to drive the top line revenues anywhere from 20 to 25% above what was already a very stable income base with the property. And so just like with these value add apartments that I know you do, taking something and doing a little better than the person before you.
So you're seeing something that has an upside and maybe you can pay more. That's how you're getting the deal, because you're seeing something that someone else is. So you're like, maybe, hey, in place cap rate, I'm paying a pretty low cap rate, but I know I can make more money with it.
That's right.
What type of cap rates do they go for, and what kind of expense ratios do they run?
Yeah, on that deal, that's an anomaly because it came with some retail. It was kind of a take all or take nothing. So it's predominantly it's garage. It was a $16 million deal. 13 and a half of that deal was really attributed to the garage. And then the office and the retail was literally, we got it for next to nothing, almost free. And so when you break it down from that perspective, we bought in right around just over a 7 cap, which if that garage was being sold as a standalone, which it couldn't, just given the underlying debt terms and things like that, there were some complexities there. But if that garage would have been sold as a standalone, and even in today's market where the debt is and all that, it would have been an institution that came in and bought it, given its location, and it probably would have traded for like a high 5 cap, maybe low 6 cap. Even with the debt where it's at today, they don't transact often. I mean, they're very desirable and they don't transact often. We just happen to be willing to take down kind of the entire pairing of all 3 of the assets. And so it allowed us to push the needle a little bit more and actually get a little more aggressive with the seller on pricing.
And is your plan to carve off that retail at some point? Can you?
Yeah.
Redid the debt?
That is it. But the interesting thing is that, so we're putting debt in place right now. We took it down all cash and it's being structured so that we've got carve outs on both the retail and the office. But the interesting thing is that the retail is stable. The retail actually is performing quite well. And it's a very desirable location downtown. It's walkable to everything. It's in the heart of all the growth in downtown. In the office, it's an interesting anomaly as well, because offices, even in downtown Phoenix, like there's roughly 30, I think it's like 38% vacancy rate right now. Like it's pretty significant. But most of the offices in downtown Phoenix are massive. You're talking like they're looking for companies that take up floor spaces of 20 to 40 to 50,000 square feet, right? Like they got massive floor. Every floor is 40,000 square feet. This is a different building. It's very narrow. It's really unique location. It's got unique architecture, and the floor plates are really, really small. And so when we took it over, it was nearly 70% occupied. It's got lots of startups in there and small technology companies. So it's a perfect size space to where the smaller businesses, they started as a solopreneur at a WeWork, which is there's one right down the road. And now they've got 3 or 4 staff members. Well, it's incredibly expensive to get an office space big enough for 4 people to WeWork. Like you're probably going to be paying like $4,000 a month for 4 people, maybe more than that. They can come to our space, get a 1,200, 1,500 square foot, very small office in ours for probably half the price of what they'd be paying at WeWork. And it's a very funky location. Again, just as walkable to all the nightlife and entertainment and restaurants. And so we literally have 2 LOIs today on some of the remaining office space. When office is not leasing anywhere else, we literally have 2 LOIs on our desk right now for some of the remaining office space that's in there. So we feel very confident we'll be able to lease that up fairly quickly and probably get it to 95% occupancy in like the next 3 months, but only because of the small floor plate size. We're only trying to lease out chunks of like 1,500 square feet, 3,000 square feet. We don't have to find a user for 20,000 square feet all at once, if that makes sense.
Right. And I think I was just at a conference that was all about retail and commercial, industrial, and those space sizes are so critical, where if you've got that, in flex, 2,000 square foot with an office is really hot. In office, not office, but retail, it's like 1,500 to 3,000 square feet. You can find a lot of tenant bases, and it's much harder to place like a 30,000 square foot grocery anchor or Best Buy or whatever. And if that tenant leaves you, you can be in real serious trouble pretty quick.
I'm not suggesting everyone go out there and find office by any means, because I think it's a very troubled sector. And we partnered, we brought in a minority partner on this that literally is probably the best in the office space in Phoenix. And they've been around for like 25 years. And so they're kind of running the show on the office and the retail, and they got skin in the game. And so like, I'm not saying we wouldn't have done the deal without them, but we brought in a strategic partner because that is not our expertise. We're parking guys, and we know that's the parking. The parking supports the entirety of the deal by itself for what we paid for it. We got a basis really low in the retail and the office, and there's a strategy there, and there's one that is pretty clear of what we can execute on. But I sure as heck wouldn't be looking at most 99.9% of the other office opportunities in the country right now, unless you're going to convert it to multifamily, which lots of guys are doing, but I think that's really the only play right now with office outside of these other little anomalies that we're talking about.
Well, and you mentioned bank-owned property, REO, like that first mobile home park you bought. And there's going to be a lot of that. I mean, there's going to be a lot of that in office. There's going to be some of that in retail. There's going to be some of that in multifamily. I mean, you look at the prices people have been paying for the last 2-3 years, and they're on floating bridge debt, and it just doesn't seem like they're going to be able to refinance or sell at the values that they need to sell at. So I think that those bank-owned properties are where you can pick up stuff for 50 cents on the dollar, sometimes even less, if you're in the right place at the right time and you got the vision for turning that thing around.
That's right.
So now tell me about the fund, because if somebody's listening and they're like, hey, I mean, parking lots seems like a great deal. I like mobile home parks. I'd like to partner with somebody that is in the space, understands all the pitfalls, and is going to probably give me better risk-adjusted returns than doing this on my own. How do you structure your fund, and how does that work?
Yeah, so our fund's Reg D 506C. We're currently in our third fund. It's SCI Growth and Income Fund 3. And there's different tiers of pref depending on what type of investment comes in. It's a $100,000 minimum investment. It starts at a 6 pref and goes up to an 8 pref, again, depending on the capital contribution. It's a 70-30 split, 70% to the LPs and 30% to the GPs. I'm not going to go through all the nuances of fees and things like that, but I mean, it's a mix. It's an interesting fund because we historically had always done single asset funds, meaning that only mobile home parks. Like our first 2 funds were 100% mobile home parks. They were diversified in nature based on location of the assets themselves and various sizes of assets. But this particular fund was an anomaly because we basically paired parking, which we came to love, and mobile home parks, and found that there were a lot of investors that, again, wanted that additional diversity of these 2 different asset classes that were very niche in nature. And so our current fund has roughly about 85 million of assets under management. We're working towards closing it out right now. We've got 2 deals, about $30 million left of assets to close on, and it'll be wrapping up August 31st of this year. But still some room left in there if someone has an interest. There's actually a lot of sweat equity. We're kind of at the tail end of it, so it's an interesting interesting time. If anyone's looking for a fund, take a look at it. We've got $20+ million of sweat equity that we built because we've been able to execute on the business plan on a number of the assets that we bought in the last 2.5 years. We opened this fund late 2020. And so the number of the assets that we bought in the beginning, they're stable. The business plan's been executed. They're stable. They've got a lot of sweat equity built into them. And we're just wrapping up with a few final investments. And it's a really good low risk time to be getting involved.
So you're able to partake in some of the deals that you took a risk on, you had a plan, but now can, like, the plan's done, it worked, it's generating cash flow, it's generating profits, and you're able to partake in that. Guys, Reg D 506C is accredited investors. So, you need to have a net worth requirement there, I think $1 million, and you need to have a income of $200,000 single and $300,000 jointly. And you can qualify to invest in a fund like that. That's what he means by that 506C. So it's not complicated. It's a form, and you probably have a website to verify accreditation. It's not difficult. So if you feel like you've fallen in that bucket, it's a good idea. If you think you're close to being accredited, it's a good idea to go ahead and get yourself verified so that hey, 506C investments are now open to me. Because there's a lot of really good ones out there that are offering better returns a lot of times than the stock market, depending on the operator, of course.
Sure. Absolutely.
And now your book, Cashflow Investor, the Cashflow Investor, if people go to kevinbupp.com/free book, that's kevinbupp.com/free book, you're going to give them a copy of this book?
That's right. That's right. They can get a physical copy of it. They can actually get a true physical copy if they just pay for shipping. I think it's $6, $5.99 or $6.99 for ship, but you'll get a legitimate physical copy, in the mail, or there's a PDF version they can download if they'd prefer to just have the PDF.
And what are they going to learn in that book?
Yeah, so I mean, a lot of it's a compilation of my journey, starting from owning a portfolio of single family rental properties to really the pivotal moment of starting to buy commercial assets and the leverage and the scale that commercial larger deals get you. And so a big part of it's about that and the lessons I've learned throughout the years. And then the other portion of it, I would say, is related to the different lessons I've learned through my podcast. So I've interviewed some incredible folks over the last 9 years I've been doing my show, some very impressive commercial developers and investors that have, done billions and billions of dollars of transactions that ultimately a number of them became my mentors. And just a lot of the lessons that I've been able to integrate into my own business that I've seen success with, I've shared in this book as well. So it's just, it's a culmination of my life experiences in the business world, as well as, the hundreds of others that I've interviewed over the last 9 or 10 years.
So it's not just a sales pitch to invest with you as an accredited investor.
No, I don't even know if there's a call to action in there as far as the sales pitch. Yeah.
I mean, we're talking real lessons, life lessons, documenting his journey and what he's learned from mentors. It sounds like a PDF that I'm going to be downloading.
Yeah, there's a bunch of free resources in there that we share. Anyway, definitely not a sales pitch at all. It wasn't intended to be that. More so, it was just it was a fun project I started about 4 years ago, and it fell to the wayside for a couple of years. And now I wrapped it up last year, and it was just a lot of fun, just really looking back and really taking a deep dive into things I've learned and things I've done. Like a lot of us, we don't, at least I know that's one of the challenges I have. We do deals and, we do big projects that we put a lot of time, effort, and energy into, and lots of stress. And I fail a lot of times to reward myself, or even to think back and reflect back on just, the accomplishment we just had. And this book actually really allowed me to reflect on a lot of times throughout my life of when I did big things or overcame big challenges. And so it was kind of fun recapping the last 20 years, which again, I don't give myself the luxury of doing a lot of times, unfortunately.
How did you get yourself out of that rut? I mean, you talk about you got kicked in the teeth. I mean, we kind of, anybody in real estate or a realtor or a contractor or a mortgage broker got kicked in the teeth. It looks like there might be some dark clouds on the horizon currently. How did you pull yourself out of that? And you said after a couple of years, you said, you're ready to do it again. You're ready to try it again. Yeah. Can you talk me about that emotional experience?
It was tough. It was really, really tough. Definitely the toughest part of my life. I mean, I'd never gone through a period like that before. Thank God I didn't have kids or a wife to support at that point. But, my personal residence went into foreclosure. I lived there for a period of time while I tried to figure life out. Unfortunately, one of my, my primary bank, like a lot of my banks were, they were basically taking back they're redirecting the income from my rental. So I wasn't living on rentals that were in foreclosure. I did have, kind of some savings, kind of pinholed for just the rainy day, but one of my major personal bank accounts got garnished. And so, I literally got to the point where I literally had negative balances in my personal accounts. Home was in foreclosure, no exaggeration at all. And, credit score ended up dipping down the 400s. And it was just a really, really rough time. I switched gears a little bit. It was all damage control with the real estate and not getting knocked on doors, getting served every day, and just trying, back then there wasn't really dedicated loan mitigation departments or loan workout departments. They had to create those due to all the fallout. And so in the first year of this all, these banks just weren't willing to work with folks. I mean, if I was able to hold on for maybe 2 years, then I probably would have been able to do better workouts with banks, but they weren't prepared to do it until they realized how bad it was really going to get, because no one knew how deep this hole was going to go. But I really just focused my efforts on health and fitness. The one thing I could control, I couldn't control what was going on, financially, but I felt that if I felt good every day and I just ate really clean and worked out, that I could at least keep a clear mind to be able to work through some of these stressful moments a little better. And during that period, I got into running. I met a girl who became my wife, right with literally at the bottom of the bottom, which is crazy. She stuck with me, and she was a big runner, and she got me into running, and I got really deep into health and fitness. And I created a couple companies that they never killed it, but they basically allowed me to keep a roof over my head and pay for electricity and bills and feed myself. And so, but it was a healthy experience for me, because it allowed me to actually make some money doing something I loved, which became health and fitness and running. It was built around running. We started a clothing company and started like an events company. And I literally did that to sustain myself for a couple of years while I was working through, again, this behind the scenes mess of all the real estate stuff. But that fire of real estate was always burning, like it never went away. And, in hindsight, looking back, I wish I would have not pull my head out of the sand, but I wish I would have looked at the other side of the equation. It's kind of hard to get yourself out of the bubble when you're inside of it, right? And like everyone I knew in Florida was like, even guys that had been through a couple of recessions before, like guys that I felt were way smarter than I, like they were crushed. And I'm like, holy shit, the world's literally, my little world's ending here in Florida and everyone's feeling the pain. And I couldn't step away from that and realize that like opportunity is here. Like now is the time to, blood's in the street, my blood's in the street, but there's other blood in the street. So let's figure out how to actually turn things around and capitalize on some of these opportunities. And I didn't do that soon enough. We still took advantage of it, once we jumped back in. But I just basically ignored the burning fire. It came about in 2011. That's when I started talking about real estate again, bought a mobile home park 2012. And then that was it, man. I literally used a little bit of savings I had, put away. And my girlfriend at the time, who was now my wife, invested some capital with me in that first mobile home park deal. I think just more so she was rolling the dice because all she knew was that I pretty much had lost everything. Right. So, and then we did well with that. And here we are today. So we're able to turn it back around, but it was tough, buddy. It was tough. Health and fitness and just focus and being present really got me through some dark times for sure.
Yeah, I love it. And I mean, that's so true with being in, it is hard to see it when you're in the thick of it. Cause I remember 2008, 9, 10, and looking back, you're like, oh my gosh, that stuff was so cheap. But at the time, it's like, well, are we even at the bottom? Is it going to get worse? Right. Like real estate is nuclear waste. Like I don't want to even touch it with a 10-foot pole.
Yeah.
Everybody's buying real estate.
If I can buy it that cheap, who's going to buy from me for more? Right, that's how I was thinking. It's like, I can buy this house or whatever for literally pennies on a dollar. But if I'm able to buy it and I can buy a lot of them, there's a lot of this out here. Like, then who's going to buy it from me for more? And how long is it going to take for it to ever come back? Will it ever come back again? Right. And so like those negative thoughts, but you live and you learn, right?
I think we're going to see some of that. I mean, with the office, right? There's a lot of it out there. Everybody on the news, how horrible office is. It's probably going to get worse, but there'll be guys that they figure out how to repurpose it into smaller spaces or apartments, or they turn it into, luxury climate controlled storage or whatever they do. There's going to be people that see, hey, I can buy this for 10 cents on the dollar. And who knows, we're all like, oh, work from home. Maybe that's just the fad. Maybe working in offices is going to come back and companies are going to see that the production value isn't really there. And who knows how the market's going to shift. And in 10 years, we're going to look back and be like, man, we could have got all that office space so cheap.
Yeah. So if that happens, like, so whoever is willing to take that gamble, there's definitely going to be people that are taking that gamble. They're going to take the gamble that they can buy things for literally a quarter of replacement cost for like next to nothing. And they're going to make the gamble that as long as they can hold on for the next 7 or 8 years, like they feel like there might be a shift back to an in-office environment. And if that does happen, number one, out of the gate, they're going to look like people will be like, you're an idiot. What are you doing? Like, it's never going back. And then in 8 years, after they took all that risk, people will be like, you were so smart, like you're a genius, lucky or whatever, what I mean? Like, no, that wasn't luck. I risked my life fortune on that gamble, and it just happened to turn out. So time will tell.
Well, Kevin, thanks for joining us. And I appreciate you telling us your stories. And it's super intriguing. Guys, if you're interested in Kevin's story, head over to kevinbupp.com/free book. If you want to look at Kevin's fund, check that out at kevinbupp.com. Thanks, man. I appreciate it a lot.
Jennings, thanks for having me, man. It's been a lot of fun.
All right, guys. Well, thanks for spending time. It's our most valuable resource, and make sure you spend some time to work on yourself and unlock your life. Peace.
This is thepodcastfactory.com.